Hello, traders. In last week's education video, we looked at psychological levels, specifically in the gold market, and how those levels help to set highs and lows, support and resistance that amounted to trend shifts or changes. And the more interesting part of that is not where a level called a high or a low, it's where it opened the door for a trader to enter an if then statement with asymmetry, i.e., ways of risking a dollar to try to make two. Since then, there's been quite a bit of volatility in gold. We had that sell off continue through the weekly open. We had a pretty strong bounce or reaction to that sell off. And since then, sellers are going back at it. So I thought this would be a really good opportunity to take a step back, to look at how those levels have played out, and then to see how a trader can implement this into a shorter term type of trading strategy. So let's get to the chart and start dissecting this. So as looked at last week, we had the 5,600 level that ultimately had caught the highs in gold. And notice how cleanly this played out. I mean, at that point, it was an all-time high. There was nothing else going on there. And the past doesn't predict the future. Let's just get that out of the way. And this is, I think, one of the reasons that many will take grievance with technical analysis, because it's illogical to expect that the past will always lead into the future. That's not the point. The point is exactly what happened here at 5,600. You can see where it's like a dead stop of resistance. Buyers aren't done yet. We get the pullback, they go right back, and then it's right here where we get a second failed test at 5,600. And then we could start to see sellers taking a bigger role. We get a pullback and then a lower high, and then a slam down to a lower low. Now, again, we looked at this last week in last week's video. That lower low came in right at 5,100. And then notice there was a response from buyers as bulls got right back on the bid and pushed this right back up towards 5,500. Couldn't quite get there, but there's something else that we'll talk about in a future video. Notice where that stall comes in, right where prior support comes in as resistance. Oh, and by the way, look at where that low had come in, right at support from prior resistance, right there, right in that same like 5111-ish kind of area. Now, what I'm alluding to here is it's called confluence, where there's multiple reasons for support to play out. There's not only the psychological level, there's also the test of support at prior resistance. Again, we'll get deeper into that in future videos. The point here is to recap the way that this week played out, and then again, to look at how traders can use this in their strategies to their advantage. Now, I'm on an hourly chart. This is extremely short term, but notice that weakness continued, and there was a propensity for support or bounces to develop around these psychological levels. So like for instance, we had 5,100 that played twice. We get the breakdown. 5K tested, leads to a pullback, holds, and then sellers eventually get it down. Again, these levels aren't going to predicate a reversal or a full stop every time. The entire point of following this is to look for an angle so that if I'm right, then I could look for a bounce that's 2 times my risk outlay. And if I'm wrong, I could get out quick and not sit here in a long position as this thing's just going the other way against me. Right? This isn't a diamond hands kind of thing. This is a logical outlay of risk management. Again, risking a dollar to try to make two. And you'll see that there's a tendency like 4,700 leads to a bounce. Seller's still going for it. Now, eventually we get this turn in here. And this is what leads to what I talked about in the first educational video on this topic of trends. So what happens here at 4,500 after the Sunday open is you'll notice there's 3 consecutive hourly candles that post perfectly right on that price. We got a swing low. Sellers are still going for it. They get penetration, but they can't close the hourly bar below that. And then we get another test, and now we get a bullish candle, and that leads to a pullback. That pullback goes right up to 4,800. And then that pulls back, and then we get 4,600. At that point, we have a possible higher low. And then once we have this, we have a higher high. And now we have a trend shift on this hourly chart. And you'll notice that a minor psychological level comes in to hold yet another higher low at 4750. 4750 is between 47, between 48, still a round number, but not as round as one of these even $100 increments. But that holds 2 consecutive hourly lows. and then we go up for the next higher high. And now at this point, we have a short-term bullish trend after that bearish reaction. So again, if you're looking to implement short-term strategy, you're looking for ways to risk a dollar to try to make two. When you get this constant beating of support at like 4,900, it opens the door for a push up to 5K. Get above 5K, all of a sudden buyers start to slow down. Then we get a pullback, and that's a lower low, and that's a lower high. We have another trend shift. At that point, at the very least, you want to be cautious of selling after that test of a next lower low off of one of these levels, right? Like we get right down here to 4,800. We even penetrate 4,800 a bit on that hourly candle, but then notice buyers respond in a pretty big way, and then we pull back and end up with another lower high. And then we go right back to 4,800, and then another lower high right at 4,900. And at this point, sellers are controlling the short-term trend. So at this point, you want to be careful of chasing the sell-off because we're off of that lower high by quite a bit. But the way to look for this is to look for 4750 to play a support, or maybe 4700 to play a support, and then look for a bounce. And then if you could add something in where like prior support comes in as future resistance, like that 4,800 level that was tested twice as support in here and previously as resistance back here, then it's even more attractive. Again, it's all about looking for ways to risk a dollar to try to make two. The aim being, even if I'm not right 50% of the time, even if I can only be right 40% of the time, I still have a model that can aim towards profitability. It's not exciting. It's not something that gets viral on social media. It's not calling tops or bottoms. It's not diamond hands, but it's consistency. It's professional. It's taking a realistic look and approach at trading with short-term market dynamics based on the structure that has been displayed for us. Now, taking a step back, again, I default towards longer time frames, more towards swing trading than short-term stuff, but this is the way that I've been treating gold for the past couple of years, where I've continued to hold a trend side bias, a bullish bias, and I'm in essence looking for ways for that trend to calm down a bit. Now on this weekly chart, it shows clearly. It's going to show even more granular detailing here on the daily, but you can see where we get these massive rallies and then we get these consolidation periods. That is called a bull pennant formation. It's a symmetrical triangle, which otherwise is non-directional because it's lower highs and higher lows. It's just compression, consolidation. But the fact that we had this bullish trend that led into that consolidation, that gives it a bullish trend side bias. And then we had another run and rally to another symmetrical triangle for like 4 months last year. Now, if you're following the headlines on this, there's usually a reason that these breakouts happen. So like, for instance, August 22nd, that was Jerome Powell's speech at Jackson Hole. That's when he finally opened up for the possibility of rate cuts. And you can see where gold breaks out in a very big way, goes right up to 43.81, at which point it stalls again, and then builds another of those bull pennant formations. At this point, it seems like we're clearly in a case of consolidation. We had that splashdown move after the 5,600 high. And it so far has held support above prior resistance with an assist from that 4,500 level. But you can see clearly off this daily chart, we're not out of the woods yet. So this is still something where I want to carry a trend side bias even on a shorter term chart, even if it's something like what we're looking at here. It's not to say that there aren't short setups or opportunities that are available. But what I'm watching for right now is the lower low that are printed at 45 with a higher low that are printed at 46, opening the door for a higher low here at like 4,700 or maybe 4,650. Again, we could look at it like a minor psychological level. Because if we do get a splashdown move, a short-term bearish trend that runs down to a level like that, and then we see a bullish response, this could possibly be, again, just drawing back to these prior examples, this could possibly be something like this. Right? You saw where we got the splashdown move, then we got the higher low, and it started slowly for a higher high and then a higher low, and then before you know it, we got the breakout, we got the continuation. That trend side run continues. But again, very clearly, we're in a period of consolidation right now in gold. It doesn't mean that the bullish trend is over. It doesn't mean that this necessarily has topped. I mean, it may have, but we're not going to know until after the fact, so it's kind of pointless even asking that question, right? The entire aim right now is looking for ways to risk a dollar to try to make two. And if this big picture trend can come back, awesome. If not, cut the losses small and try not to expose yourself too much to any one idea. That, my friends, is what I have for today. That's what I have for this week on the education side. Thank you for your time, and as always, happy trading, ladies and gentlemen.